Imagine a multinational corporation suddenly taking on $1 billion in debt, but legally hiding that massive weight from everyone who looks at its books. For decades, companies could do exactly that, using an accounting standard known as the straight line method. By renting massive assets like office buildings, retail spaces, or aircraft fleets instead of buying them, they could write off those rentals as simple daily operating expenses. This accounting quirk kept massive multi-year financial obligations completely off the official balance sheet. Investors and lenders looking at the math saw a pristine asset-light operation, missing the billions of dollars locked up in binding long-term rent. The rollout of a new global accounting standard, IFRS 16, brought that era of corporate secrecy to an end. This rule forced companies to place those hidden lease obligations directly on their main books, exposing the true scale of their financial commitments for the first time. The central mechanism of IFRS 16 is straightforward. If a business signs a contract for the right to use an asset for more than a year, that contract must now be treated almost entirely like a purchase. To make this work, the standard forces two new metrics onto the ledger. The first is the right of use asset. This quantifies the exact financial value of the company's contractual right to control that plane or building over the agreed lease term. The second metric balances it out, the lease liability. This represents the present value of all the future cash the company will owe over the life of that contract. The only ways to legally avoid adding these massive numbers to the balance sheet are if the lease is shorter than 12 months or if the item being rented is exceptionally cheap, like a basic office printer or laptop. By forcing these twin metrics out into the open, a business burdened by heavy rental obligations can no longer mask them to appear artificially lean to the public. This diagram outlines how lease accounting functions over time. Once the initial recognition happens and those numbers hit the books, the math splits into two ongoing tracks as rent is paid. On the first track, every monthly cash payment chips away at the total debt, meaning the lease liability steadily shrinks. Simultaneously, the right of use asset gets closer to its expiration date. It loses value, and that loss must be recorded on the income statement as ongoing depreciation. Getting those initial numbers right requires a lot of estimation. Accountants have to predict the likelihood of the company renewing a contract, calculate potential penalties for early cancellation, and choose complex discount rates to estimate current market values. Modern accounting has transitioned from historical record-keeping into a process of active strategic forecasting. When this rule took full effect, an estimated $3 trillion in hidden lease commitments suddenly materialized on global balance sheets. This chart highlights the immediate impact on standardized metrics. Notice how the EBITDA bar artificially shoots upward in year 2. Because rent is now categorized as depreciation and interest instead of a basic operating expense, earnings before those factors look heavily inflated. But as that metric spikes, others crater. Return on equity drops, and internal debt-to-equity ratios explode upward as the new lease liabilities hit the books. These sudden shifts caused immediate ripples through financial markets. Lenders had to quickly reassess corporate credit ratings, renegotiate covenants, and adjust borrowing costs to account for all this newly visible leverage. A company could have the exact same daily operations and cash flow as the day prior, but to the stock market, its financial health looked entirely different. To handle this new reality, corporations are now required to publish extensive qualitative notes proving exactly how they arrived at their massive new lease figures. This is a real consolidated statement of financial position from Play Communications. Right near the top of their non-current assets, we see the newly added right of use assets line, placing hundreds of millions of zloty directly onto the official ledger. In this subsequent disclosure from the same company, you can see the effort required to justify those numbers. They publicly detail expectations for renewing telecommunication sites and map out exact interest rates to discount future cash flows. By stripping away the ability to classify massive rentals as simple operating expenses, IFRS 16 brings the true scale of corporate financial commitments out of the shadows and directly onto the balance sheet.